Welcome to another episode of Break Away from the Rat Race. And today I have the pleasure of speaking with Richard Thornton. Richard has been an active real estate lender and investor over the last 30 years, so lots of experience. He co-founded a commercial mortgage banking company that had about an $8 billion in portfolio and assets under management, and it was sold in 2000. So that I'm sure that went very well. And he has syndicated senior facilities, flipped houses, and has been doing hard money lending. For the last six years, that has been kind of his focus, has been as a managing principal of American Note Capital. And so he's basically doing mortgage note investing nationwide. He does about 50 to 75 of these transactions annually. So Richard, welcome to the show.
Thanks, Eric. I'm glad to join you and look forward to our conversation and answering people's questions.
Yeah, so there's a few things definitely that I want to touch on, and we're going to get to that. Definitely the seniors facilities. This is something that I had looked at before, and it is a very interesting space for me. I'm still interested in that. And then also the note business, note industry, and how to think very creatively about lending, about borrowing money. It could be a hard money lender, it could be private money lenders, or all kinds of things. So I always like to talk about that, be more creative on the lending side. But before we get to all that, tell us a little bit more about kind of like yourself, your journey into the flipping, and why you decide to go into hard money lending and senior facilities.
All right. So a quick thumbnail is that when I came out of school, I got a master's in finance, decided I wanted to be into real estate and really focused on syndicating properties. At that point, I was working for a large home builder that was doing syndications. And we started a small savings and loan, which actually in the savings and loan crisis went belly up.
Yeah, that's what I was wondering about that.
With everything out of that.
Oh, really? Wow.
But in a true Phoenix situation, a partner and I started our own commercial lending group. And we did, for the most part, larger loans, $10 million minimum size, all over the country. And it worked out very well. As you noted, we sold that in about 2000 with an $8 billion portfolio. So we were actually at that point larger than some small S&Ls.
Nice.
It was a small boutique firm. And out of that, I started lending on seniors facilities, larger facilities, and found out about them. Mm-hmm. Found out about the numbers, how they worked. And when we sold the company, I went to a number of my clients and said, hey, how'd you like to do deals, be investors? So at that point, we were doing triple net leases. So we would approach Sunrise Senior Living or whatever operator it was. Let's say a typical building would be a $20 million purchase. I would raise $5 million. I'd go out and get financing for 15, and mm-hmm. we would own it as a syndication for 10 or 12 years. At that point, operators really liked to do that because they were making higher profit margins on their operations than were on their real estate.
Exactly.
Funny little thing called the recession came along after that. And as part of that, I thought, well, I've still got some clients who are fairly well off. Let's start a little hard money fund. So I had an informal fund, and I had anywhere from $4 to $6 million out at a time. Most of my renovations were smaller, so that was actually a fairly decent volume. And from that, found out about actually purchasing mortgage notes, which is what I'm doing now, both performing and non-performing.
Mm-hmm. Excellent. So let's dive into the senior housing. In my book, Stop Trading Your Time for Money, I touched on that, on senior facilities and also medical buildings and stuff like that as a way to get passive income. But I put them in a quadrant along with mobile home park, along with PML, hard money lending, and owning, turnkey rental properties. And so tell us a little bit more about kind of like, what do you think, does it take in order to, in terms of time? I always look at the resources that you need in order to get these things off the ground. A lot of the investors, they have a full-time job, so they don't have that much time to get started on some of these strategies because they're very time consuming, or they don't have that much money to get started. So tell us more about what does it take to get started into senior housing facilities as an investor, in terms of time, resources, any kind of special skills that you need, or team members that you need to have on the ground?
Okay. So if you want to I'll split the market into larger facilities and smaller facilities.
Mm-hmm.
Smaller facilities are usually what's called board and care. The larger facilities, if somebody wants to invest in those, I would suggest that they go to a number of the different REITs, real estate investment trusts that are out there, and invest through them, because frankly, the dollar amounts are just too large to get into those. As I said before.
Oh, even for the small one, it's too large.
Yeah, I would, that's an easy way for your clients, your listeners to get in, which is actually invest in a REIT or a group that's owning large facilities. So that's the large end of the market. If they want to be a little more active and get into the smaller end of the market, which is facilities that range anywhere from 6 beds, which can be a large house, up to 36 or 50 beds, anything like that. They can put those deals together themselves if they want. They would probably have to do it with somebody else. They have to be a little more active. There are some syndicators out there that do focus on the smaller end of the market. And for that, you can probably get it for $50,000 or something like that. But again, it's going to be a syndication.
Yeah.
If they want to be really active, then what I would suggest is just looking in their local areas. Stay local and find out what some of the board and care facilities are in their area. Find out who owns them and talk to them and say, look, can you tell me about what's going on in this area? Because it's a really small group and they know exactly what's going on. And actually, I think you can start your own board and care facility. If you have a house, like a 6-bedroom house or something like that, it has to be configured correctly. In other words, it can't be a 2-story house or anything like this, but lots of times you can buy a 4-bedroom and split some of the rooms to make it into 6, this type of thing. And find out who some of the local operators are. There's the not to single any, ethnic group out here, but the Filipino community tends to be very effective and do a very good job in this area. So you can contact with an operator that does that. And then if you do that, they can operate it. You lease the building to them on a triple net basis. They're responsible for all the operations. You don't have to get licensed for doing that. And it's a much better execution for them.
Yeah, that's true. So definitely, because you don't want to get into owning the nursing part of the operation. I mean, you don't, unless you have the skills necessary for that. You want to get an operator, and then they run their business and they just rent the property from you. And then triple net, the advantage of triple net obviously is that they pay all the operation. They pay the property taxes, they pay the utilities, they pay everything. So that's the advantage of that for sure.
Yeah, even if it's only a double net where you're having to do the roof or something like that, that's fine. There's a lot of different ways to carve this. But the point is, as you accurately said, you don't want to be part of the operations at all. There's all sorts of licensing problem. I shouldn't say problems, situations that you have to go through. And the typical real estate investor is just not equipped to do that.
Yeah, and exactly. And then the other thing too, that when I was looking at it, it was also pretty complicated in terms of there was nursing homes, there was like senior facilities, there was all kinds of different levels of care in that space, and every state was a little bit different into how they categorize the different care that was needed. Some of them needed a doctor on board. Some others needed, they didn't need to have a doctor. So there was different level of cares that were needed there. So,
right. So the big distinction used to be that it was considered more or less a nursing home or nursing facility if the staff had to give shots. So if you had to get some sort of insulin or anything like that, any shots, that made it a nursing home. Otherwise, it was just assisted living.
okay.
It's got a little bit murkier now because you can have an assisted living, you can have an independent living, but you can bring in a home health care person to give you shots. So that's now quite common, and actually is a little bit less expensive for the client if they are in an assisted living and somebody just drops by to give them a shot twice a day or something like that.
Yeah. Okay. So that's very good. So basically, recommendation if you think anybody's interested into the nursing or senior home facilities is really find an operator first and start building the relationship there, and ask them kind of like what they want, what they need in order for in terms of real estate. Do they need more homes?
Yeah,
Where do they
exactly.
need
Because
them?
they may say, well, we have X number of parts of town covered, because usually these have a lot of facilities have like a 5-mile radius, meaning they could service people from farther away.
Yeah.
But if you have your mom in a facility, you don't want to drive more than 5 miles to put her there.
Yeah.
So you have a circumference. So they could say, well, if you could buy a home in this part of town or this part of town, it would give you an advantage, and I would be more likely to lease from you. So things like that.
Yeah, exactly. And they could also probably share the configuration that they're looking for.
For sure.
Right. So that all the details. So it is significant. So I mean, even the renovations that are needed and all of that, it's a little bit more extensive, I would say, than if you just do a regular flip, or if you do like a BRRRR strategy where you're basically renovating a home for rentals. These are more, these are more exhaustive. You have to have like obviously a ramp. You have to have special doors and all of that, and and restrooms and handrails and all of that.
Exactly. You have to have handrails. You have to have 36 wide doors. You have to have ramps. That part of it can get expensive.
Yeah, exactly. So that's why a little bit more money is going to be needed up front, maybe to get that off the ground. Sometimes this is something that you can tag along on your lease as well, with if you build to use or renovate for their own personal use. So that's something that maybe you can discuss with your assisted living provider to kind of like bump up the rent to pay for these renovations. But so a little bit more extensive. But in the end, what are we looking at in terms of a typical cash on cash return? I would say after you've done your financing, what could you be looking at?
Well, that's actually one of the nice things. I think you can certainly start out at a 10%. And if you build in CPI increases, consumer price index increases, you have to look at these as long-term rentals. I mean, nobody wants to do all this and be in and out in 5 years.
Yeah, exactly. Yeah.
But you can build rent increases in there, and over the course of 5 years, something like that, you can beat a 12 or 15% return, which is pretty nice.
Yeah, that's very nice. Yeah. And also this is a tenant. Imagine you have a tenant, that assisted living group, they're renting it, and they're not going to rent it for 1 year or 2 years. They're going to want to rent it for 5 years, 10 years or more.
Yeah, I would say more like 10 to 20 years.
Yeah, exactly. So you have a solid tenant in there. So in your lease, you want to make sure that you build in the inflation adjustment and whatnot in there.
Correct.
Yeah, exactly. So that sounds like a very interesting strategy. I think, and I think that's the right approach. I mean, it's really getting to network with these people and then find out what they need. Especially from my perspective, I don't not really know So I don't really know exactly what they need, what kind of configuration they need in which area, like you mentioned. So, so that's a good approach. So if any of you, our listeners, is interested in that, just go and search for these kinds of organization and start networking with them. The other thing too that I was very interested about is that you decided to go into the notes business. And I know that you have, you have a lot of experience. You have a master's in finance and all of that. So you already know all the ins and outs of that. So it was probably a natural fit for you to end up being as a notes investor at the end. So tell us a little bit about that transition into the notes business with American Note Capital.
So, yeah, as I mentioned earlier, I was a hard money lender, and being a hard money lender is pretty straightforward. As you know, you're looking at the real estate. You're probably at 65, 70% loan to value. You're putting the money in and charging whatever rate, and you're in and out, hopefully in a year.
Mm-hmm.
Notes, though, even performing notes can be very different. It's a
Mm-hmm.
very different animal. You have a whole lot more flexibility as a mortgage lender
Yeah.
than you usually would. One of the advantages of being a note investor is that even if somebody defaults, and that's I always talk about the big D, the
Mm-hmm.
default, because that's what
Yeah.
everybody's afraid of.
Yeah.
You have flexibility. When I look at a note and underwrite a note, and I should say that whether I'm investing in a note for myself or I think I'm going to broker it, I assume that it's going to be in my portfolio.
Mm-hmm.
The reason is it might be for a long time. I have a lot of notes that will sit there for 3 or 4 years, and somebody will finally decide that they want to buy either a partial, which can make a very good return for somebody, just sort of a set it and forget it,
Yeah.
or a whole note. If somebody defaults, you can always rent the property.
Mm-hmm.
You are probably, notes I buy, I'm usually probably at 50% loan to value.
Mm-hmm.
So if that's the case, or investment to value, I should say,
Yeah.
that's the case. If you have a $100,000 house and you've only got a $50,000 investment, you
Yeah.
have to ask yourself, even in a slow market, it might take me a while to sell it,
Yeah.
but somebody like yourself might buy it
Yeah.
and do a turnkey on it, and boom, you're out. Or some other note investor might buy it.
Mhm.
So there's several different ways that you can get out of these. I like the fact that I can generate income without the hassles of being a landlord. A lot of my clients like partials. The yields
Mhm.
on partials are a little bit lower,
Yeah.
but it means that I get a very good return because I get the tail end of the payments.
Yeah. Yeah.
If it's a 25-year note, I sell the first 10 years. I
Mhm.
basically, for a relatively modest investment myself, get the payments on the extra 15 years.
Yeah.
So
Yeah, that's pretty amazing.
I
That's
like
pretty
it.
amazing. When I first went and learned about the notes business, I thought that was phenomenal. That people would actually take a series of payment, and so they have obviously the whole loan, let's say 30-year loan, and then they would just carve out and say, okay, well, I'm going to sell the first 10 years to somebody else, and then I'm going to keep the last 20 years. And I thought that was so creative and so different than than any other kind of business. And people don't realize that you can just go and carve out a portion of your payments and then sell that. There's a market for selling that a portion, the partials of a note. So I thought it was very interesting.
Right. And you mentioned earlier that a number of your clients and listeners have a regular W-2 income day
Yeah.
job. And notes is something that you can get into slowly.
Mhm.
I jumped in full feet first because I had the ability to do that.
Yeah.
I didn't want to, I'm in my 60s now. I didn't want to start something brand new. I had 70 people working for me in my
Wow.
mortgage company. And
Yeah.
I don't need that anymore.
Yeah.
I can do this with
Yeah.
a couple of virtual assistants and things like that. And a number of my clients, quite frankly,
Mhm.
are people who have come to me. They have regular day jobs. They want to transition out of those.
Yeah.
And usually what I tell them, it's about a 3-year transition period.
Mm-hmm.
Um, and they can learn from me. They'll buy a partial from me or something like that, and sort of learn the ropes.
Yeah.
And then I always suggest actually that you get some training. You
Mm-hmm.
go to Note School or one of the other different groups that will give you some training, because even though it costs you up front, you don't know what you don't know.
Yeah.
And I'll give you just a really quick example. PaperStack is a good exchange to go to. There's a lot of, you have to be careful of what you get there, though. A doctor client of mine who thought he really knew how to invest in notes very well came to me and he said, "Richard, why should I buy something from you and only get an 8% return or whatever it was?" He said, "PaperStack will sell it to me to a 13."
Yeah.
And I said, "All right, let's get online." We both went online, both looked at it. And I very nicely told him that it was a very nice asset, but it was in a city that had a 20% poverty rate. He had no exit because nobody was going to be able to buy it.
Yeah.
As long as his client was in, or his borrower was in there, that was great.
Yeah.
So yes, it was a 13% deal because there was no exit.
Mm-hmm. Yeah.
So you have to learn that kind of stuff. You have to
Yeah.
know how to get to that.
Yeah. Yeah, exactly. I mean, you still need to understand the real estate piece of it. You are, in fact, I mean, you're relying on that piece of real estate to support your loan. You have to act as if you're investing. And that's what you called it at the beginning, is that your note is really the amount you put up is really, you are investing in that particular property. And so I think you need to understand the market that it's in, the condition, and all of that, and what's the value of that building if you have to foreclose on the house and sell the property. How long is that going to take?
Yeah, and there are lots of, as with anything, there's lots of tricks in the trade. There's lots of tricks that I mean, you focused your practice on 4 very distinct cities, and you have crews that can do the flips, and that's the way to successfully do that.
Mm-hmm.
In my instance, I try to look at buy notes on houses that have overlapping economic areas. What do I mean? So let's say you've got city A and city B, and they've both got 20-mile radiuses where people can work. Well, I want to buy something that's in the convergence of that.
Yeah.
And another thing I'll say is I'll look at a note and I'll say, or a house, and I'll go, how far is it from a Walmart? This is just called the Walmart rule. Well, why would that make a difference? Well, because Walmart is not going to put facilities. They have only closed, out of all of their facilities, I think they've only closed like 5 in the US. They do very extensive market studies.
Exactly.
They can tell you about the economic viability and Home Depot of that area. If there's no Walmart within 10 miles, think about it.
Yeah, but I mean, that's true. I mean, they do extensive research because they're going to put a significant amount of money and investment in that facility. So, I mean, employees and ramp up and, change their supply chain and all that kind of stuff in order to open that store. So, if you can align yourself and your strategy with, and it works and it makes sense, align that with a big player like Walmart. And rely on their study in order to help you find the right city, the right locations for you to invest. I think that's a very smart strategy.
Yeah, and if you're lucky enough to either be close to or to live in an area that's fairly a low-cost area, you and I are both in California, so I don't do a lot of note business. I do some partial business, but I don't do a whole lot of business in California because it's very difficult for me to say to you or one of your clients, "Eric, would you like to buy an $800,000 note?"
Yeah.
Doesn't work. As you know, outside of Akron, Ohio, and Indianapolis, and I've got some notes in markets that you're in, St. Louis and around.
Yeah.
You can buy a nice little house for $100,000. It's got an $80,000 mortgage on it, and they make nice little investments.
Yeah, no, I think that's just very good. For me, like I actually looked at doing that for our houses and basically buy notes on properties exactly in markets that where we're in. And I also talked to other notes investors too that were buying basically non-performing notes, what even performing notes, but they were investing in notes in Memphis and Cleveland. And I said, well, if you ever have to go and they go in default and you have to foreclose on the property, just give me a call and I'll just buy the property from you for as long as it all makes sense for me as well. But yeah, I mean, I was all open to that. So so that made a lot of sense for me as well to kind of go in there. We know the market very well. If you tell me this is the house that has a note on it and this is where it's located, I know exactly what I can sell that house for. So there's no hesitation on my part. And so the next question is kind of like, it's more like the economics of the notes and how it works. And so,
right.
So if you're very familiar with the market or get familiar with the market, I think this is good. You're doing it nationwide, so that must be a little bit more tricky, but you have a lot of experience behind you. But somebody that wants to get into the notes business and build a nice little portfolio to diversify from single family rental and other types of investment that they might have, what kind of do you recommend that they should stay in their backyard, or is there some states or metropolitan areas that you think would be a good place to start for new investors?
Well, the first thing I would do is I would say get some training. Find a reputable person. There are a few traders out there that, frankly, are not all that reputable. So do your due diligence. Buyer beware. But once you have done that, yeah, I think it's easiest to do something that's sort of in your backyard if you can, or close to. I have. It's funny how different clients want to buy things.
Yeah.
I have one client who lives in Atlanta, and he wants to buy notes that are within driving distance. Because he likes to hop in his car with his wife on Saturday, and they go and they visit all the different houses that they own notes on, and it's just fun for them. They're getting decent returns. Some people say, well, if I live in the Midwest, I want to be totally diverse, meaning I want something in Indiana, something in Ohio, something in St. Louis, because if a hurricane comes through or whatever, they don't want their whole portfolio wiped out. I've got another investor in Ohio who only wants Ohio notes. So it depends on but I would say it's easier if you live in an area outside of California, or I shouldn't say that. It shouldn't be too broad with California. The Central Valley is a very good place, much lower cost. You can do
probably like Fresno and stuff like that. And
exactly.
So you brought something up as well. When you own a house, typically you would have insurance on it, and then you find if there's natural disasters often are not covered, but something happened, burns down and all of that, then your asset is protected because you have insurance. But when you own a note, I mean, you're kind of removed from that. So how do you ensure or that person has the right level of insurance to protect your asset?
Okay, so your servicer, and I will suggest that everybody use a mortgage servicer. Don't try and service these yourself. Should pull the insurance every year, and you have to be named as a beneficiary on that insurance. Now, you can only obtain insurance for the mortgage amount. You can't obtain insurance for anything in addition to that. If they don't do that, there's something called forced place insurance, which you force it upon them. You have to pay for it during the term. But it's usually not too expensive, frankly. And in the case it burns down or something like that, no pun intended, it's good insurance.
So another good point here, note servicing. It may seem easy that you're just going to get a check for the payment of the mortgage and that's it. But there's a lot of other requirements that are needed in terms of preparing statements and stuff like that for the borrower, and also like there's tax things that you have to report. There's a whole bunch of other stuff that you need to do, and there are services out there called note servicing companies, and then they're basically going to handle all of that. They're going to have like direct payment method. They're going to send you a statement. It's kind of like a property management company, but for your notes. Except there's no toilets, nothing.
Right, and they specialize in. I mean, a lot of these groups actually were when the recession came along, when groups like Metropolitan and whatnot got rid of all of their housing because of the recession.
Yeah,
there was a lot of people in a lot of these servicing departments and things like that that didn't have jobs, so they started their own companies. So you've probably got a dozen of these companies around the country that do a very good job at servicing these notes. And you're right, they do have to be CFPB compliant. There's a lot of things you can or can't say to the borrower. I can't call them up and say, what's your credit rating or anything like that. So it's costs vary, but it's very worth your while to have a servicer in place.
Yeah. Totally agree. The other thing is, so what I've done also, I mean, I'm talking about creatively using notes. Personally, I have done a few houses. I probably did like six or seven houses on seller financed. So basically / installment sale. Basically putting a note, selling the single family rental to an investor, and then putting a note on it, and then they're paying me for the note, because these investors, they didn't have W-2 income. But they had other sources of income that made sense. And then obviously this was our property. We were intimately knowledgeable about the property, the tenant that was in there, and the level of renovations that had been done. So that was a good way for us to kind of like recoup at least some of our investment dollars into that property, and then kind of put it to the next house and stuff like that. And
you bring up a good point, which is, somebody can, in their own backyard, and I would suggest doing that, go out and buy a house, renovate it, and sell it and carry back the note. And then they've, as you just said, have done that for themselves. That's a nice little way to build up some long-term cash flow and avoid immediate tax hits.
Yeah, especially if it's an investor. I think if you're selling it to a person that's actually going to be an owner occupied, somebody that's going to move in, I think in some states you're required to go through a mortgage broker or something like that, or I forget what it's called, but
it's a mortgage underwriter. There's one group in particular that I know of that will do just that for you. For I think it's $450 or $500. They will underwrite the borrower for you and say, do you want to make a loan or not? And again, it's compliance.
Yeah,
and they are completely compliant when they do that.
Yeah, exactly. So that was for us as since we're selling to investors, then we kind of like bypass all of that. So there's no need for that at all. So that was very good. Any other kind of use of notes that could be beneficial for someone who wants to build a portfolio? They may not have all the they may not have a W-2 income. They may not, but they need to have other people's money in order to achieve their goals or to invest and stuff. Is there anything that you would recommend in terms of kind of like using notes as a way to bring more money to them to invest?
Yeah, a lot of my clients use their self-directed IRAs. So let's say you have a W-2 person and they've got a 401k. They can move without any penalty, all or a portion of that 401k to a self-directed IRA and then use it to invest in notes. You have to remember that, let's say you buy a note at an 8% yield. I'm just pulling that out of the air. If you sell a portion of that note to somebody else, that's going to increase your yield significantly, even if you only sell 3 or 4 years of that.
Yeah.
So you can do that inside your self-directed IRA or not.
Yeah.
You can do it with a small group. You can do it form an LLC with a number of your business associates, everybody throws in $20,000 or whatever, and then it grows. One thing I tell my clients is that if you can buy a number of notes, so let's say you buy 5 notes, $250,000 investment, so $50,000 a piece.
Yeah.
Even if you only get a 6% return on those,
Yeah.
if you reinvest that money, so you don't take any of the proceeds out,
Yeah.
and you reinvest it, you will find out that within about 21 months, you can buy another note, and then 18 months, buy another note, 17 months, 16 months. Over a 10-year period, you will have about 13 notes.
Wow.
At that point, you will be generating close to $12,000 or $13,000 a month income.
Wow.
You also will have more than doubled your yield and doubled your principal. So you wouldn't want to sell those all at the end of 10 years. In my example, I just use that cutoff horizon for analysis sake. But it's a very attractive way to invest in notes.
Yeah, and I think it's a good way to diversify as well from from single family rentals or multifamily rentals, and have on the side another type of investment that is also passive income that's coming in. So I think that's a very good way to manage your funds and invest, I think.
Correct.
All right. So Richard, so it was a pleasure. So before we wrap up, tell our listener kind of like where they can reach you. And I know you're also, we haven't really talked about that too, but you also still do hard money lending. So if people they're looking for funds for projects and stuff like that, I'm sure you won't mind if they contact you. So, but my question to you is like, where can they contact you? Where can they find you and talk to you, want to learn more, and maybe get some loans, hard money loans?
Okay. So thanks very much. So my 800 number is 800-508-5212. That's 800-508-5212. My website is www.amnotecap. That's AM notecap, NOTECAP.com.
Yeah.
You can schedule a meeting with me through the link on there at any time. Or you can email me at richard@amnotecap.com.
Okay. Do you do any kind of like mentoring or coaching as part of your?
Yes, I do. As a matter of fact, some associates and I, thank you very much for asking about that, are just completing a course of study that will walk you through the entire process. It's going to probably run $1,200, $1,500, something like that. So it's not too expensive.
Yeah.
But it's a very good primer. You can also go to my YouTube channel. Just go to YouTube and put in American Note Capital. I have a series of 9 videos that run 8 to 12 minutes a piece, so they're easily digestible.
Yeah.
And that gives you a very good feel for what's required. It's nothing fancy. It's just me sitting at my desk talking.
Yeah.
But it's just good, solid information.
Okay, great. And with that, would that be enough information, or you still to get started, or would you recommend still to take like a more in-depth course from some of the training?
Yeah, I think you still need it's a good way to get started. You still need more information.
Okay, excellent. Well, Richard, it was a pleasure speaking with you. And I hope our listeners are going to go and reach out and then learn more, at least about the notes business, and at least watch your videos and see what it's all about. So thank you very much.
Thanks very much, Eric. I really enjoyed this. And if anybody needs anything, just give me a call. I'm always willing to just help out and not sell anything. So.
Yeah, excellent. Thank you, Richard.
Thank you.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.